I'm your host, Joanna Makris, and today we're back talking about SPACs, special purpose acquisition companies. As many of you may know, the world's largest SPAC, run by Bill Ackman, Pershing Square Tontine Holdings, is the subject of a lawsuit filed by former SEC Commissioner Robert Jackson and Yale professor John Morley. The complaint alleges that PSTH is an unregistered investment company and that particularly sponsor and director warrants represent unlawful compensation under the Investment Company Act. And joining us today to discuss the lawsuit and its implications is William Birdthistle, law professor at Chicago-Kent College of Law. Welcome, William.
Thanks very much, Joanna.
So let's start from the top. From a legal perspective, very simply, what do you think is the problem with SPACs?
Well, the problem being alleged in the lawsuit is that SPACs are operating as something called investment companies. There's a third security statute that most people don't know much about called the Investment Company Act of 1940. And what it says is that if you're operating something that is legally an investment company, then you have to register it or have an applicable exemption from it. And the lawsuit is saying that what a SPAC is, or at least what Bill Ackman's SPAC is an investment company, and he hasn't registered it. So that's the easiest, simplest legal problem facing him right now.
So in terms of PSTH, why do you think PSTH was targeted initially for this lawsuit?
There's a couple of reasons. The first probably, I mean, I'm reading tea leaves here, but the first probably has something to do with the fact that it's so big. It's a $4 billion SPAC. It's the most prominent in the industry, and therefore it attracts a lot of attention. A second reason might be because it actually conducted its affairs in a way that's different than most SPACs. Specifically, I'm referring to the proposal that it acquire a minority stake in Universal Music Group. And the fact of the matter is that the definition of investment company turns on whether a company is primarily engaged in the business of investing. Most SPACs will say, listen, we're going to merge with a business eventually, and then that's the business we'll be in, whatever that is. The problem is that if you propose to acquire only a minority stake, then you're investing in that business. You're not really running that business. And I think the problem is that if Ackman's SPAC had acquired a minority stake in Universal Music Group, you couldn't really say that they're now selling records or whatever it is that UMG does. Instead, what you'd say is they're investing in it. So those two reasons, the fact that it's really large and that their proposed business transaction wasn't a merger, it was just a minority stake. Those are two things that attracted, I think, attention from plaintiffs' lawyers, and I think arguably make the plaintiff's case easier. Again, the entire case is going to turn on whether the company is an investment company, and acquiring a minority interest makes it look more like it is.
Right. So it appears that Ackman has navigated around some of these concerns with a new structure called a SPAC. Can you explain really what that is and whether or not that does navigate around some of these concerns?
Sure. The first, yes, that's no doubt that's true. Within 48 hours of receiving the complaint and the lawsuit, Ackman published a letter to the shareholders of Pershing Square saying that he was going to offer this SPAC as an alternative. The problem legally for him and Pershing Square is that if in fact a court determines that he's been operating that SPAC as an investment company for the preceding 12, 18 months, then it's kind of too late. He will already have violated the 40 Act. So there's not much he can do to navigate around that. But certainly going forward, it's a model that maybe he and others will try to adopt. What the SPAC does that's different from a SPAC is it doesn't ask for all the cash up front. So the way a SPAC typically works is the SPAC will go public and the sponsors running the SPAC will receive and raise however many millions, hundreds of millions or billions of dollars they want at the IPO. And then they'll keep that war chest for however long they need until they consummate the merger. What a SPAC proposes to do instead is to say, listen, we will get promises from you, all you investors. We won't actually take custody of your cash until we need it, until we actually have the merger in mind. And there's a couple of issues for Ackman. I think it's possible that will skirt the definition of investment company, and so it will avoid the problems of a lawsuit like this. The problem, though, is it's a brand new model. So the SPAC model has not been used, and it hasn't, more importantly, it hasn't received SEC approval. So what he's proposing to do is a new model, and he doesn't have approval for it yet. And if you think that all of this kerfuffle is attracting attention from the SEC, and now he needs SEC approval for this new model, there's a high risk there that he won't get it. So the SPAC idea so far is just one idea by Ackman, and it's not at all an industry standard, and it hasn't received any formal approval yet.
Are there any other potential structures that are being talked about that may be more amenable to regulation?
Well, as a securities lawyer looking at this issue and looking at the definition of investment company, the first thing that comes to my mind, and I'm sure to many others, though I haven't seen it discussed much publicly, is that the trigger for becoming an investment company is actually engaging in the business of investment. So if you raise that $4 billion and you wait 24 or 30 months for the merger, typically what companies tend to do, SPAC companies tend to do, is put that money while they're waiting, they put it into investments like ETFs, money market funds, treasuries, things like that, all of which are securities. And that's the problem. That's what triggers the definition of investment company. So one way to avoid that problem would simply not to invest in those securities. You could hold it in cash instead. Now, normally, most people in the investment world would say that's crazy. You can't raise such a large amount of money and then keep it in cash. You're foregoing all those potential gains. But in this environment where the interest rates and the yields on those kinds of securities are really, really low, I'm not sure a whole lot is being foregone if you kept it in cash. So if I were starting a SPAC tomorrow and I had to try to avoid the reach of the 40 Act, just keeping the investments, keeping the assets raised in cash seems to be the easiest, most obvious way to avoid it. The problem, as I mentioned earlier, is that if you've been running a SPAC differently for the last 18 months, it's a little too late. If a court determines that this is a violation of the 40 Act, then you've already violated it. But if you're looking for a new model going forward, keeping it entirely in cash is certainly one way to evade the reach of the 40 Act.
Got it. So if this lawsuit prevails and the court rules that SPACs should be considered investment companies, what are the implications operationally for SPACs and the equities that we're looking at as investors?
Yeah, it's a great question, because I think many people would simply say, what's the big deal? If it's a 40 Act company, fine, then just register, just do it. The problem is that unlike the 33 and the 34 Acts, where registration, it's not easy, but if you want to file an S1 under the 33 Act, you can kind of do it, and it requires primarily disclosure. Just tell us what you're doing. That's what a typical IPO registration statement says. Here's how we run our business. The 40 Act is different. The 40 Act does require registration, usually under a Form N1. That's sort of a parallel document to an S1. So you do have to divulge all that information about what you're doing. The difference is that the 40 Act also requires you to change the way you do business in a lot of material ways. So one way is just that 60% of your board has to be independent. You're required to have a certain amount of diversification in the assets you hold. You're not allowed, and this is the big one that's alleged in the lawsuit, you're not allowed to engage in affiliated transactions with yourself. So remember, the compensation for sponsors in a SPAC to promote is a scenario in which they get a certain amount of the proceeds that are being raised, sometimes a pretty high number of that. That would be prohibited under the 40 Act, even if you registered. So the problem for SPACs is that registration is a headache and expensive, but that's not the real dilemma. The dilemma is you also have to conduct your affairs in a certain way that's basically antithetical to the ways in which SPACs want to do business.
I mean, it sounds like this could really potentially halt, M&A, merger transactions among SPACs if this prevails.
Yeah, I mean, it's certainly a threat. There's no doubt about it. And we know it's a threat for a couple of reasons. First, you can just look at the lawsuit and come to that conclusion. But more importantly, Ackman said as much. In his letter, again, within 48 hours, he said, basically, we're going to redeem the fund. I mean, that's a pretty large concession. He said in the letter, I think the case is without merit. But if you're offering to redeem $4 billion, that's a pretty strong backhanded compliment that you think that the case has some legs. The other item was something on the order of 50 plus law firms within 10 days of the complaint wrote a joint letter, which is unheard of for law firms, saying, we don't think SPACs are investment companies. That's awfully quick for a legal analysis. The letter didn't contain any legal analysis. I think what it bespeaks is a strong concern with the possibility that all the M&A activity from SPACs may go away. So I think you're certainly right that a reasonable observer would think that the lawsuit and the attention the lawsuit is generating with regulators, perhaps, poses a threat to ongoing SPAC M&A activity. But from a narrow legal analysis, that's not necessarily true. If the plaintiffs have in fact picked a SPAC that's particularly problematic, so if we think that Pershing Square, or a court thinks that Pershing Square is particularly troublesome because of that issue that we discussed earlier, where they chose to invest in a minority, or they proposed to invest in a minority stake of UMG as opposed to a full merger, a court could say, this SPAC is problematic. This SPAC is a 40 Act company, without actually affecting the other 1,500 SPACs. Now, I think there's a chance they may do that. That would be a reasonable judicial approach. Many courts like to do the minimum. They don't like to pass sweeping rules if they don't have to. They just want to rule on the issue before them. So that would be a scenario where Pershing Square has trouble, but the other SPACs don't. The problem, of course, is, most prudent, conservative, reasonable observers would fear that this is going to cause a large chilling effect more broadly across the industry. And if you're a potential merger target, you have to be pretty brave to look at this lawsuit and contemplate a future merger with even a different SPAC and think it'll be fine, it'll be no problem. I think most people would say, well, let's take a look and see what happens. What is the court going to say here? What are the regulators going to say here? So yeah, I think the concern you suggested in your question is not unreasonable. I think prudent, cautious people would wait to learn a little bit more about how this unfolds.
Right, that makes sense. This space has already come under fire for kind of loose, suggestions of loose financial disclosures, some creative accounting, guidance that's multiple years out into the future. And now, given there are more eyes on the space and potentially the SEC, moving in, what are your views on potential regulatory tightening of SPACs?
Yeah, there certainly have been moves in that direction, and it's kind of impossible to ignore them. So many months ago, a director at the SEC gave a speech in which he raised some of the issues that you just did, where he said, the compensation here is kind of unorthodox and it's very high, and it's hard to be certain that the shareholders are getting a great deal out of it. That's SEC speak for we're concerned. It's a little bit modest, it's a little demure, it's not bomb throwing. But to people who work in this area, that's a real signal. The other thing was there was a signal much more recently, just a few days ago, where the Investment Advisory Committee of the SEC adopted a plan to solicit specific information about the operations and finances of SPACs. Now, one thing that the industry and that law firm letter we mentioned a second ago said is that tons and tons of SPACs have received approval from the SEC over the last 18 months. So hasn't the SEC given their blessing? Now, again, I think most securities lawyers would know that simply getting your paperwork processed by the SEC does not constitute an endorsement or a blessing by the SEC. In fact, it's very commonly the case that when there's fraud or allegations of misdealings, plaintiffs will sue on documents that have been processed by the SEC. Nobody in those situations says the SEC blessed it. It's just like you turned a form in and the government accepted it. So similarly here, I think, it's very difficult, I think, for a reasonable observer to say that the SEC has been blessing this process for 18 months. And now when they've actually taken an affirmative step to say, well, we're going to solicit information and really learn a lot more about this area, that is not uncommonly a first step towards a regulatory approach. First, let's gather the data. So yeah, putting those two things together, plus the prominence of the lawsuit, I think it's a reasonable guess to assume that the SEC may clear its throat and make some more sort of concrete guidance in this area in the coming months. And again, if I were a participant in this field, I might want to be cautious and wait to see what that guidance is. If you barrel ahead full steam with an M&A project, it's expensive. You need a lot of investment banking time. You need a lot of lawyers' time, some accountants. Those deals are expensive. And if those deals end up being, undercut, then you'll have spent that money, futilely. Mm-hmm. So yeah, I think a reasonable observer might want to know more about what the regulator is going to do, and I think they might also suspect that something's coming.
Yeah, is there a possibility that they could be outlawed altogether? That SPACs were ultimately a transient vehicle for the public markets, and it's game over, and we go back to purely traditional IPOs?
I'd be surprised if that happened. That's, frankly, that's rare. That almost never happens. So if you look in the past when very popular fundraising mechanisms have been looked at by the SEC, almost, at least in my knowledge, rarely, if ever, does the SEC say, you can't do that at all anymore. So 50 years ago, people used to do corporate spin-offs as a way to skirt the IPO process. A private company would merge with a public company. The public company would then distribute the shares of the private company to its public shareholder base, and voila, you have an IPO without having gone through the IPO process. The SEC said, we think you need to declare a lot more information about that, information that's commensurate with an S1. That is to say, we're not banning spinoffs. We're simply saying that you need to treat them the same way you would treat an IPO, and that immediately shut down that business. Companies still do spinoffs all the time, but they're now primarily led by business motives. They're not led by an effort to skirt the IPO process. Similarly, ICOs, initial coin offerings that we heard so much about 3 or 4 or 5 years ago, they were all the rage, big buzz. The premise of those was that they're not securities and therefore they didn't need to be registered. And again, after 18 months, a year or so, the SEC bestirred itself, took a closer look, looked at one of those deals and said, that might be a security. Again, not saying you can't do it. It might be a security, therefore it might need to be registered. And that also cut down a ton of activity. You don't hear much about ICOs anymore. So if I were to guess about SPACs, if there were to be some regulatory intervention, I'd be very surprised. I'd be shocked, frankly, if they said you can't do a SPAC. I think simply they'd say, if you want to, you just have to register and abide by the 40 Act. Or you could take the approach we mentioned earlier, which is just keep all the proceeds in cash, and then you haven't triggered the 40 Act. So again, neither of those would constitute an outright ban. The first, though, would be so prohibitive to the business model that I think people wouldn't want to do it. The second, I don't know. In a low interest rate environment, I'm not sure what the big problem with the second approach is. Again, it's a problem for the people who haven't been doing it, but for a new SPAC created today, I presume they could continue that way. So no, I don't think it'll lead to an outright ban.
Right, but it does sound like the bottom line is you think changes are on the way.
Oh yeah, I think almost certainly. I think right now there seems to be a large holding pattern. I mean, not entirely. Occasionally you still hear of more business going on in SPACs, but I think most people looking at this litigation that we're discussing, the Morley-Jackson litigation against Pershing Square, I think there's very much a wait and see, a holding pattern. Let's see, litigation is often quite lengthy, but there are some early initial steps that give you a signal. So there's a motion to dismiss stage pretty early on. If the court does something dramatic there, we might know a lot more. And also, as we just said, in a couple of weeks or months, it's not inconceivable that another SEC piece of guidance or signal might come out that would tell us more. But yeah, I think it's more of a holding pattern than a shutdown. And I think people will be watching very, very closely to see what's coming, because yes, as you said, I think it's highly likely changes are coming.
And what do you think, if I'm a pre-merger SPAC right now, what's your advice to me, and what these companies should do operationally, if anything, right now?
If I were a SPAC, I'd be certainly tempted to move my proceeds into cash. And then I could make a claim that under the definition of an investment company, I'm not engaged in the business of investing in securities, to be quite clear. I might try to consummate my merger immediately to have it done. That's hard, that's bold, that's dangerous, given everything that we've just discussed, but it would certainly get you out of the space quickly. But I think what's done is done for most of the existing SPACs. I think if I were looking to do something, preventative, I would be looking to create new SPACs that just didn't invest the proceeds in securities. On the other hand, who knows? Maybe we've reached peak SPAC. By the time that celebrities are running these things, and it's gotten this much attention and it's attracted this much litigation, maybe the bubble is burst. Maybe it's time to move on to other things. There's a lot of other ways to raise money. And yeah, like I said, when I see a long list of celebrities leading these, it starts to lose a little bit of credibility as a vehicle for promoting the greatest and most insightful investment going forward. So maybe they've had their run. I don't know.
Yeah, I think you hit the nail on the head. Thank you. This has been an exciting conversation, and thank you for joining us, William. And again, we'll talk to you soon, and please join us again for the next Behind the Wall. Take care.
Thank you.